Hello and welcome, everyone. I'm excited to have you on today's webinar with Chandan Economics here. A little bit about what to expect. Our goal for you today is to leave this webinar with a better sense of where the economy is heading, how it affects you as an investor, and insights and trends that we've gathered from over 35,000 landlords on rental management systems and tactics that are helping them stay profitable today in 2026. So, we're in for a treat today. We have John O'Kane from Chandan Economics. He's the vice president and head of research at Chandan Economics. If you joined us back in January with Sam Chandan, he was closely involved behind the scenes in the research for that session. John holds both a degree in economics from Pace University and a master's in real estate finance from NYU's Schack Institute, where he is a real estate finance an inaugural Hirsch Fellow. John spent over a decade leading research partnerships with firms like Arbor Realty Trust, SVN, and the National Rental Home Council. And his work is closely cited in outlets like CoStar News, Globe Street, BizNow, Business Insider. And today he's going to walk us through where the economy is heading and what that means for you, for rental housing operators in 2026. I am also joined with Dylan Szeto, our business intelligence manager and adjunct professor at Pace University in economics. He specializing in housing economics, data products, causal inference to help property owners like you turn market analytics into scalable investment decisions. So with his background in economics from also Chandan Economics and and credit research at Fitch Ratings, Dylan provides deep technical expertise in market trends, and Dylan's going to be sharing with us the trends that he's seeing across RentRedi's customers and translating those into actionable insights that you can today take to to create more stable cash flow, increase your ROI, and ultimately reduce some of the headaches. So thank you both, John and Dylan, for joining me. We'll be passing it off to John first, and John will take us through an update on the economy, rental growth, and lending for the next 15 minutes before we pass it off to Dylan to go through some insights on profitability that he's learned through studying over $35 billion in assets across the platform. And then we'll open it all up to you to ask some Q&A, ask your questions to John and Dylan about anything you'd like. So without further ado, John, happy to pass it off to you.
Amazing. Thank you so much, Ryan. Going to start by sharing my screen. Can you confirm that you can see these loud and clear?
I can.
Amazing. So what we're going to be doing today is really trying to set the context for where we are within the macroeconomy, as well as where we are within the rental economy, and that interplay. We'll start by really kind of framing it with headline real gross domestic product. So this is the overall speed of the economy, and what I like to point out here is we've had quite a last number of years, even beyond the pandemic, looking at 2022, 2023. Really in 2022, we had the cost of living crisis. The last year, I would argue that we've been operating on a minute-to-minute economic and news headline basis really since Liberation Day, and even more recently with the war in Iran. But if you really kind of assess the underlying growth of the U.S. economy, and it's operated pretty consistently, even with all of the noisy volatility that surrounded it. Last year, just above 2%, total growth for the year. We've been kind of sitting around that, low 2% growth for the last number of years. So, as we kind of talk through, some of our expectations, including some of our pessimism going forward, I think it's worth kind of, framing this with we have an expectation of, not spectacular, but steady growth as being kind of the norm and kind of what we expect. With that being said, if you look within the labor market, it's slowed, and for a number of reasons. A lot of this being demographic, with the number of retirees that are leaving the labor force on a day-over-day basis, as well as from differences in immigration policy. We saw that pre 2025, the net or the non domestic born portion of the labor force was growing at roughly a 5% year over year growth rate. That had really kind of been a lot of the engine of new labor force growth in recent years. So with those two kind of components, going, swinging more negative, we have less fuel to kind of put in the tank to speed along the labor market going forward. What I also like to put here is, we're kind of hovering right around that zero growth line. So we're certainly not falling off a cliff, but we're also in a moment where we're not really adding as as quickly as we had. And really going back to real GDP as far as our underlying growth, there's really only two things that can help us grow as an economy over the long term. One, we either need more people doing productive things, or those people have to be more productive. And this is just saying one of those two ingredients is going to have less, we have less of that in the kitchen in order to make our productivity, our GDP cake. With that, this is looking at the market's expectations of inflation over the next 5 years. How we calculate this is we have government debt. Some of it is just saying, hey, here's what we'll pay the yields on it, and they also have for the same term, hey, we're going to offer you some form of inflation, some form of real inflation protection, and looking at the difference between those two those two interest rates, we can get what the market's expectation is for break-even inflation. And the reason that we really care about this is, expected inflation is built into every long-term interest rate that you and I look at, whether it's mortgage rates, whether it's we're going out for new debt on a multifamily property. All that's going to be embedded in there. And you've seen over the last year, kind of a reacceleration of sorts back to 2.7%, what the market expects inflation to be over the next 5 years, what it's going to average. And kind of even bringing this further back, even in 2022, when we had inflation around 9%, the market's expectation of the 5-year forward period from then was still about 3 to 4%. So we're still sitting structurally above where we expect, or rather where the Fed wants inflation to be in order to closer to that 2% benchmark. And what this really means for borrowers on both the investment as well as the home ownership side of it is that interest rates are unlikely to kind of come back to a 2022, 2023 level, or 2021, 2022 level that was very accommodative. So from an investment standpoint, I think that translates to probably a little bit more realistic about the debt assumptions that we're going to have to take a couple years in the future. But at the same time, it's not like we're going to see a large portion of rental demand all of a sudden be able to afford homes at a much higher rate because of a rapid increase in affordability in mortgage rates. This is a little bit more of on the pessimistic side. There's a lot of different sentiment indexes that we can look at, but this one that I really like that the New York Fed puts together. This really has the survey respondents assess their personal financial situation, both from today as well as what they expect 1 year from now. And as you can see, that the red line being how you are performing today compared to 1 year ago, that for the last number of years has been consistently negative. So the net share of Americans saying they're doing better off has fallen to about net negative 20%. So as we kind of look through some of our rental performance data, and we see some economic exhaustion and declining performance over that period, I think this partially speaks to that. But then also I'd like to take a quick look at the black line, which is your expectations for 1 year ahead. And that consistently is above the red line, and consistently from 2014 to pre-pandemic, that was a pretty positive net share of Americans that were extremely or consistently positive about their economic standing in the year ahead. But you've seen that kind of putter along right around 0% some volatility over there over the last number of years, and really between February and March with the start of the U.S.-Iranian conflict and the increase in oil prices as a result, you've seen that go from right around 0%, net, with people saying better versus worse, to a pretty negative 10% of people thinking that next year is going to be worse than it is today. So as we're kind of framing ahead, our expectations for the U.S. economy, you look at some low end expectations from like the New York Federal Reserve and other economists. It's somewhere between 20 to 30%. You listen to Mark Sandy, who's the chief economist over at Moody's Analytics. Dylan and I, within the world of economics, we're kind of lower level clergy, but he's kind of our Pope in the Vatican. And their model puts it closer to around 48, 49%. So somewhere around a coin flip. I think that a reasonable expectation for the year ahead is probably somewhere in that middle ground. And to the point where, hey, maybe it's not our modal expectation where we think it's going to happen, but it's certainly an elevated chance of a technical recession that we have to take seriously. From that, bringing it into the apartment and rental economy, now that we've kind of framed the macro context, I'd like to make a couple points. The first being that even if we haven't gone through a technical recession in the last number of years, the apartment sector has. We've definitely had investment recessions over the last number of years, and in many ways, a lot of that correction is behind us. So we'll look through some of the pricing trends. I think that we're actually in a moment right now where apartment pricing has stabilized, and I'm pretty hopeful going forward, independent of the macro environment. So I think that gives us a little bit more of defensive positioning going forward. Capital markets are backing that up. You start to see a little bit more loosening from the lender perspective. At the same time, you're seeing some additional headaches that are popping up from defensive refinancings. And then across the board, rent growth has been fairly widespread. And then lastly, we'll talk about some of the data that you guys and us put together between Chandan Economics and RentRedi, some of the performance trends that we're seeing there, and before we kind of talk it more from an operational perspective with you guys. So this is just really talking about the pricing trends within the apartment sector. As you can see, we hit a peak in 2022 in July, and compared to the commercial real estate sector more generally, the pricing reset has been more severe within apartment. We've seen apartment prices are down by almost 20%, and that tells us that we're currently sitting at a pretty healthy discount compared to those peak prices. At the same time, we've seen prices more or less stabilize around that discount for the last for the last year and a half, since December 2024. So that is both. I think that gives me some confidence as far as current pricing, and that it's more likely to have a bias up than down in the months ahead. And I think that the lenders agree. These are data that are taken from the Senior Loan Officer Opinion Survey. So these are the head underwriting officers in the U.S. And you see all that red above the line. Those are lenders tightening the reins, saying that, hey, we're going to have to pull back and really be a little bit more conservative about our underwriting. But in Q1 2026, for the first time since 2022, you saw a net positive share of lenders saying, hey, we're willing to loosen it up a little bit. And part of that is from, starting from a very tight base. And the other part of that is really from, confidence in that recovery, that stabilization that we just talked about a moment ago. From there, something that we're definitely watching in the market, definitely a lot more in the last couple of months, is a little bit of stress coming through maturities and refinancings. About 30% of agency-written debt is less than 10 years. So these are starting to be loans that were originated in 2021, 2022 at 3% interest rates. And what's happening is those are coming due, and it's creating a little bit of a headache for properties that don't have the cash flows with the ability to absorb that 6, 7, 8% potentially interest rate. And you're starting to see that reflected in the underwriting. So I think what you're currently seeing is refinancing cap rates are revealing some of the stress underneath the hood. However, a big question for us is this translating into more distress throughout the market, or is it just revealing stress? And as you can see, the blue line there being acquisitions, at the same time that we're seeing rising cap rates in refinancings, we're seeing dropping cap rates in acquisitions, which is suggesting that no, we are not seeing this, translate into more distress. It's not causing distress. It's just helping us show what's already there. And this is talking about, this is probably one of our more complex slides, so I'll take 1 second to walk it through. Just the red line being the share of markets that have rising rents on a year-over-year basis, and the blue line showing rising rents on a month-over-month basis. As you can see right now, about 2/3 of markets have rents rising on a month-over-month basis. So a very healthy majority still have the default being growth. However, if you compare that to where we were when the market was exceptionally tight in 2022, which was about 95% of markets with growing rents, we're certainly not there, but we're also not in 2017 to 2019, where roughly 3/4, 75% or so markets were rising on a month-over-month basis. So right now we have a wider dispersion of markets. We have a lot more markets that are not having rents rise on a month-over-month basis, places in the Sun Belt that have seen some oversupply, but still to categorize the market as anything, we still have a default of growth, and I think that sometimes this gets lost. From here, let's talk a little bit about what we've been tracking together in the independent landlord rental performance report. So these are on-time rental collection rates, really kind of bringing it from the tenant to how this translates to the pockets of landlords. And what you've seen is from 2023 to early 2025, you saw a little bit of a slide in the performance in the on-time rate. I would argue that in 2020 and 2023, the market was exceptionally tight. So those are probably on-time collection rates that we might have. If we had more of a pre-pandemic benchmark, we might say, hey, this is cyclically above what we'd expect. So I think that coming into 2025 is right around where we would expect normal to be. But then we saw a pretty rapid deterioration in on-time collections in 2025 throughout the spring. And the question is why? Are people not paying their rents? Are people paying their rents late? And if with that, why? And the answer being it's almost entirely due to an increase in late payments. We saw that late payments averaged above 10% for pretty much all of last year. I don't think that we really, between 2021 and 2024, we really, I think we averaged closer to like 7 or 8%. And last year we were, I actually have it right here in front of me, so it's closer to about 9.5%. And last year we were much more in that 12 to 13% range, which is extremely elevated from what we had grown accustomed to. A number of factors that we can point to, some of that economic exhaustion that we were talking about before, as far as renters living on the margin, higher cost of living, but also date back to May of last year, mandatory collections of student debt started to go into effect. So as wages were starting to get garnished, that may have had an effect on household balance sheets that were living on the margin. But at the same time, we've started to see a little bit of stabilization, and just going back here, a pickup in recovery towards the end of last year and into 2026, which we're hopeful about. But even with those higher late payments, the upside being that landlords are eventually getting their rent. This is looking at the full collection rate. So this is on time plus eventually received late payments. And even with going up to roughly 13% late payments, the full collection rate last year sat right around 96%, which was above where we were in 2024. So it's not to say that late payments are harmless. If you're a landlord that is matching together your monthly cash flows with your debt payments, that this is a recipe for a massive headache every single month. But at the same time, if you have the buffers to absorb it, this is really helping to contextualize the scale of the stress that was last year. It's, hey, yes, there were the timing issues. However, the best that our data says, whenever renters could catch up on rent, they were still very much prioritizing it as an expense that they most wanted to catch up on. So I think this helps to kind of put the full situation in context. And with that, I've grown tired listening to the sound of my own voice, and I turn it over to you, Ryan.
Thanks, John. I appreciate it.
Of course.
Um, it was great to hear all the insights and love hearing from everyone else in the chat too. Feel free to share your biggest takeaways or pop in questions. We'll make sure to answer your questions after this next segment from Dylan. Dylan, I know you have some really interesting insights into what landlords are doing to get paid on time. It ties in closely with what John's talking about here. Would you like to take us into that?
Absolutely. There we go. And sorry, it's just uploading. It's taking a second.
No worries.
Great. So we're going to talk a little bit about some of the research RentRedi has done and with regard to things that have helped landlords get paid on time, share some tips and tricks for looking at listings and reducing vacancies, and then ultimately talk about a metric called gross yields that we've done some work calculating from using data on our platform from landlords and property managers just like yourselves. So why on-time rent matters, a basic coverage. It keeps your cash flow steady for bills, repairs, and operations, as well as it helps protect the tenant-landlord relationship through things like trust and reliability. One of the really interesting insights we had when we looked at it, we looked at our automatic rent reminders data. So basically, if you're a tenant, we do this thing where we send an automatic rent reminder. You can set it yourselves, landlords can set it, but basically we looked at tenants who received automatic rent reminders and tenants who didn't, and we found that automatic rent reminders makes a really big deal. So you'll see these numbers, 38% and 58%, 38% for no reminders and 58% for automated reminders. And basically, this is looking at tenants who were already, they did not pay their rent on the day it was due. And then we said, okay, they got a rent reminder after they're already late. Did they end up paying by their grace period, which is when they would have to pay a late fee? And most of them actually end up paying. So really cool, really interesting to see these automatic rent reminders in our surveys. Both landlords and tenants tell us it's super important for them. It's the most selected option for how do you get to on-time rent payments for both tenants and landlords. The next thing is we looked at the impact of credit reporting on-time rent payments. So when we look at tenants who have credit reporting, they are 11 percentage points higher for on-time rent payments. This makes sense. This is supported by other economic research that have done similar studies for credit cards and mortgages that credit reporting truly helps. Truly helps the on-time payments and people feel more incentivized. Something that's really interesting about payment method preferences, this speaks a little bit to trying to keep good tenants there. So when we look at the actual usage, the self-reported actual usage from a survey, we see that there's some misalignment between tenants and landlords, right? So ACH bank transfer, pretty in line, it looks all good, but then we get to credit and debit and cash and checks. And so landlords are telling us that they are using cash and checks a lot more often than what tenants' preferences are, which is really interesting. So a lot of landlords, you may be able to keep a good tenant or something by using their preferred payment method, like credit or debit card, instead of taking that cash or check. So we do a rental investment sentiment survey. So this is really interesting. So we asked, what is the biggest challenges that people see coming, our landlords and property managers see coming, and 54% said they see increased cost as their biggest challenge coming. So over half. And those top cost pressures are actually rising insurance and property taxes, with maintenance and repair costs also increasing. So some really interesting stuff there. We're going to speak to a little bit about different ways that we can protect cash flows given that people are concerned about their rising costs. The first thing is to review your finances more often. You can check your P&L monthly and basically catch trends early. So if you are a property manager or landlord looking at your P&L, you might be able to catch like a leaky pipe, leaky faucet, the same bathroom needing repairs more often, and it will help you there. You can build a cost buffer, sort of that kind of mindset. So budget for rising taxes, setting aside budget for preventing maintenance of getting things like the roof looked at and stuff like that. You could read quote policies maybe every couple of years and consider meeting with a tax strategist to figure out the best ways you can do this. And then just focusing on operational efficiency, so automating rent and maintenance workflows, sort of like things you can do through automatic rent reminders, having your tenants set up autopay. We have a ton of success with tenants on autopay. Protecting cash flow by using tenant screening and cutting manual work and inefficiencies out. So this slide, reducing vacancy. So the rental housing vacancy is about 7% at the moment, according to the latest government data. You could time your leases strategically, like some of the, rental demand normally peaks in the spring and summer. However, there's some evidence that peak demand is actually moving earlier in the year, so that wisdom that was like sometimes in May, getting closer to those summer months, it actually peaks. Well, there's some evidence that post-pandemic, between 2023 and 2025, that demand is moving earlier. So paying attention, especially in your sub-market, could really be interesting stuff for getting tenants and moving your rentals into a point where there's peak demand into a market. Pricing correctly from day one. So overpricing could lead to longer vacancy. Take into account when you're listing in market comps. And then list like you're competing, using good photos, detailed listings, really selling your property is huge. But one of the things I forgot to mention is like the automated lease reminders is super important as well. For that, it's one of the features landlords really like on our platform. It really helps. It really helps to make sure that you have that you're ready to list your property and such, so that you don't miss a month's worth of rent. And then we're just going to talk about this metric called gross yield and or gross rental yield. And gross rental yield is basically just taking the annualized rent over the property value. Right, and this is a really helpful sort of like quick metric you can use when you're just looking for properties to see if they align with your investment goals. Getting to a cap rate could be something a little bit different, or net operating income could be like a little bit more challenging. But even myself, I'm currently looking to obtain another rental property, and I was just looking, and just all I did was just looked at the price of the property, and I searched what did it last rent at on the last listing it had, and I just did that quick calculation to figure out that it's actually a property I'm not really interested in investing in, but it's super quick. You could do it all through sort of like the listing data. But rental yield is basically just a measure of the income efficiency. It shows you how much rent you earned relative to the price you paid. And the importance comes in when you really think about how long it would take for the property to pay for itself just through rent payments. So if you invest $100,000 at a 3% yield, it would take you over 33 years to pay it back. At a 6% yield, it's cut in half at 16.7%, which is obviously a huge difference for how fast you can get it. So higher yield is just about basically what's your payback. So we look at our own data, and it's data that comes from our own landlords in particular. So this is people who are typically, mom and pop investors. So typically we see the lowest yield markets in sort of like coastal markets, places that are tech and lifestyle hubs, where they typically have high property cost. But the benefit there is truly the long-term appreciation of the property. So you might get some really good properties there. Every market is sort of like, in some market you can find good deals anywhere, but the benefit here is truly like the long-term appreciation. And then people who might be considering more of like a cash flow strategy. So the highest yielding markets typically have lower barriers to entry in terms of price wise, and you can sort of align that with rent payments, and you typically get a higher gross yield. So at the high end, you typically see a 14 to 15% gross yield. It has favorable housing costs, and truly, if you're prioritizing cash flow, this might be a really good place to go and look. They tend to be smaller markets than what you would see for, like in what you saw here, which are typically some of the largest markets in the U.S. But you don't necessarily need to look into these smaller markets to also find good deals. Our data also shows that you can get sort of a balance between appreciation and rent growth, places that have typically been associated with more steadier markets by looking at some of these markets. So a place like Pittsburgh, El Paso, where I had previously owned a property, Jacksonville, these places are could be considered maybe like a little bit better of a balance sort of investment return between some appreciation and rent growth. And with that, I will pass it back to Ryan.
Thanks, Dylan. Appreciate it. Interesting to see the impacts of. Oh, has my video dropped on us? It's just dropped on my side. No luck. Sorry, everyone. Here we go. All right. Thanks, Dylan. Appreciate you going through all of that. It's great to see. Love seeing the causal effects of different impacts like rent reminders, credit boosting, other things that you can offer control to ultimately get the same quality tenant to pay you on time more often, which is a nice change. So for everyone watching, definitely let us know your takeaways again, any questions you have. We're going into a Q&A session now where we'll answer your questions. I know some of you had submitted questions ahead of time, so we'll make sure to start off with some of those questions you have for those, but then we will go into the live Q&A questions as well. So to start us off, we have one question from Ray Ann. Ray Ann Anderson had asked, could one of you comment on rent growth in the southern regions? Could one of you comment on that?
I could take that one. So I mean, we track this. We use data from Zillow, and when you look at it, it's within the southern region. That is where you're seeing those month-over-month declines, and it makes sense. That's where a lot of the most enthusiasm was. During 2021, 2022, as far as net domestic migration, everyone moving in, and I think that it's hard to calibrate future demand with having to put shovels in the ground and get supply up to that. You're shooting at a moving target, and I think that what has happened very much in very many ways is a lot of the developers there have gotten over their skis, especially with the low cost of debt environment that we're coming out of from a couple of years ago when a lot of these deals were struck. And so you're definitely seeing a little bit of a mismatch right now between the onboarding of that supply that was committed to a couple of years ago with some normalized demand levels. With that being said, I think that the headaches that we're seeing right now in very many ways are temporary. A lot of the growth fundamentals that were in those markets a couple of years ago, it may have slowed down a little bit, but these still remain the growth magnets of the city, of the country, excuse me. Our team did a quick look just a couple days ago as far as work from home demand, and you look in places like New York, Chicago, and you see 30%, 40% drop offs in work from home demand. But if you look in the southern region, especially the Carolinas, especially Florida, I think 7 of the top 10 were in Florida. These are places that compared to 2021, where we hit peak work from home demand, we've actually seen increases in these markets, not decreases, which tells us, from other parts of the country, if you are locationally independent, not tethered to a desk, and have the ability to optimize your housing decision in some other way, you're probably going to be looking for things like, better climate. Yeah, I love New York. I don't mind the cold, but I get it. A lot of people don't. Um, Not everyone could like skiing. You want to have a lower cost of living. Not everyone likes to live in a $4,000 shoebox, and probably a lower tax environment. I get the decision why people choose to move to some of these places, and a lot of those incentive structures remain very much in place. So I think that zooming out or a couple of years down the road, I think a lot of the supply headaches that you're seeing right now are very much short term.
Hmm. I love it. I love it. We have another question here from Jane Clare. She asked, over the next decade, where will risk-adjusted returns be the strongest in secondary markets like Waco, Texas, Class C, B, A, and what structural factors will drive that shift?
You want me to take that start with that, Gwendolyn? Or you have a. All right. So I cannot pretend to be an expert on Waco, Texas in any way. Um, Not too far long ago, I thought it was pronounced wacko. But it, I stand by that a lot of the opportunity is going to be in that class B, class B plus space. I think a lot of the incentives that are moving into the market are really on workforce housing development. I think that a lot of the attention had been on the lower end of the income scale. A lot of the private development had been on the upper end of the development scale, and there's a big question of everyone in the middle being like, hey, I'm I don't have enough to afford highly amenitized residential, and I am too rich to afford any kind of government subsidy. What about me? And I think that has really kind of been the missing portion of the debate. And I think that there's been a growing conversation and consensus. It's one of the few things that really does kind of unite the aisles across federal, state, and local government is the need for a cost of living, especially within housing, and kind of adjusting that issue. I think that there's a lot of room for policy to go wrong, but you see a lot of creativity and a lot of room for policy to go right. So I think that within workforce development, middle income housing development, this is a lot of where you're seeing a lot of incentives move into. So I think that if you are concentrating into the space, looking at assets that are potentially going from indisposed to really kind of elevating it and be able to capture some of those incentives that are being put in place, I think a lot of the risk adjusted return is going to lie there.
I like it. We have one other question from Mia Rune. A bill was passed blocking large investors from buying up rental properties. This would ease housing prices, but will it have an impact on smaller landlords and their current rental properties?
So I'll start by saying this is only past the Senate,
Mhm.
and I don't really see a path for it to pass the House. I think that there's enough division there that this is not going to happen during this session, and I beyond that, I don't know if the industry is doing a good enough job as far as telling a story, but I'm certainly one that believes that this is a lot more red meat populism than it is something that actually helps to improve housing affordability for either renters or for homeowners on a forward basis. A lot of the core problems that people have with SFR and BTR is the argument that this is Wall Street coming in and purchasing homes from mom and pop owners or for owner occupants, and that was really only the case pre 2012. Coming out of the financial crisis, you had players like Blackstone saying, "Hey, we believe long term in the U.S. housing market. We see assets right now, pennies on a dollar. No one's able to buy it. No one wants to buy it. Let's buy it." With the assumption that this is going to appreciate and recover in 5 years. And once they started those large scale acquisitions, they said, oh, maybe we should make a little bit of cash flow right now. And they started into the property management, that really kind of seeded the institutional SFR market. However, once prices really kind of recovered back to back to health, it really didn't make sense for large-scale institutional investors to kind of come in and compete with mom-and-pop owners, or I should really just call it owner occupants at that point. If I'm going to be living there for the next 20, 30 years, I'm probably willing to overpay slightly versus someone that has to kind of hit an investment return. If the price goes up, 4 or 5%, your pro forma is out the window. So you even see this within the data that there's a 12, 13% average different valuations between what an investor single family home goes for versus what an owner occupant goes for. So that's all to say that I really don't think that this bill is necessarily going to pass right now, and if it did, I don't think it helps to move the needle. As far as really the heart of the question, bringing it back to smaller operators, I'm not sure if it means a huge difference either. I think you can make the case that perhaps there's a little bit less competition if some of those larger operators end up getting disseminated from the market. However, I think that some of them will be clever with certain JV structures. So is there a path for it to kind of move the needle? Sure. I think that it would have to be very intentionally written legislation, and I think that it would it need to look different than it currently does. But I'm not convinced it's going to pass. I'm not convinced that it's going to have an effect if it does.
Fair enough. Fair enough. We have a question here from Aber asking, what is the relation of rent and recession, inflation and job loss?
Dylan, you want to take this one? You're the professor here.
I'm the professor. I am a professor, so that's not a lie. So the relationship between rent, recession, inflation, and job loss, I mean, I could try to tackle these sort of one at a time. So between rent and recession, right, obviously as people tend to lose their jobs, as GDP sort of contracts, we're at a weird point when we talk about recession where job growth seems to be kind of tepid over the last 12 months. We've had months where it's really good, months where it doesn't look so good. So job growth typically over the last 12 months has been kind of tepid. And so if we were to talk about the relationship between sort of what we could expect between rent and recession, typically if you are expecting places where there's a lot of job loss, where there's a lot of unemployment, a lot of people on insurance claims, you could typically expect probably your rent to either decrease or to just stay flat over time. Some research that was done during my time at Chandan Economics, we looked at the relationship between the on-time payment rate and the initial unemployment claims and searches for employment benefits in Google, and we found that there is a relationship between on-time payments and unemployment claims. So the relationship there, typically recession doesn't necessarily have to mean bad things for landlords. It's very local. It's very market driven. But I would typically say that recession would typically mean probably a flat environment for rent. When it comes to inflation, the relationship gets to be a little strange. You could have inflation be flat for all other products other than housing, which has been the case in the past, or be very strong for maybe something like healthcare. So rent with inflation, I mean, typically those two things would tend to move together. So if you have housing higher costs in general, then landlords will raise their rents. Do you think I missed anything, John?
No, I think that pretty much hits the mark. I mean, that's a lot of the value of investing within residential real estate is you have the ability to reset, to adjust for your costs, so long as demand supports it on a year-over-year basis. So it tends to be one of the more inflation-protected asset classes. I will say that some of the traditional relationships that you and I look at throughout history as far as do we usually expect inflation to be falling during a recession potentially. Um, some of these line up for an interesting moment where some of these relationships might not necessarily be holding. I'm getting a little bit of background noise from yours. Just want to mute for a second. There you go. Sorry about that. Um, but I think that really you hit the nail on the head, Dylan. And uh, I'll make the case that, as I did earlier in my presentation, that we've been in moments of recession, especially within the investment market, within the commercial real estate market, within the apartment market. We've had what we expect from a recession over the last number of years. As a result, I do think that it creates a little bit more of a cushion for us. It's not like prices need to reset because we expect what have you. It's we're at a moment where things are priced attractively. We're far off the market peak. So I think that on a forward basis, even if the economy runs into a little bit more trouble, there's more confidence in current pricing. And if we I could imagine a world where we run into a recession this time around without incurring major job losses. I think that's also something we're saying. Even as we are, might not be adding jobs at a very high rate month over month. I think that we're more likely to be in at a knife's edge, but clinging to that knife's edge and not necessarily falling off at a slow and stable, low hire, low fire labor market, which more or less means that, hey, you might not be able to juice the rents as much because there's not as much opportunity in the labor market with people being able to improve their situation and then being able to move up the ladder and you having the ability to raise the rents as a result. But at the same time, it's with that, as a good chance that people are retaining their jobs, retaining their ability to pay their rents. So I think that some of the downside possibilities in that type of recession might be somewhat mitigated.
Awesome. Thanks, John and Dylan. This next one's from David, and it's a little bit market specific, but he was asking in today's market in regards to loans. He's looking in the Phoenix market area for low property tax properties. And so he was asking, is it the time to buy to rent homes?
Dylan, you want to take the first crack?
You
are the one investing in El Paso. You're the one investing closest to David.
Yeah. So, it's hard to say, whether it's the right time to buy or sell, right? Like it's completely dependent on the portfolio, what the risk tolerance. So saying whether it's the right time to buy or sell can be a little bit difficult. I will say there are some times right now, depending on what you're looking at. I would imagine Phoenix has some pretty strong in-migration. I imagine that trend has continued. I'm not sure what's going on with like housing supply specifically there, but there could be signs that now is the right time to sort of buy. This depends on your portfolio. Like it's not unheard of too if you have shifting environments where maybe it could be time to sell depending on what your portfolio goals are. It's really, really dependent on your individual portfolio, and selling doesn't necessarily mean reducing your total asset holdings. It could just mean like trading up, right? You have a property that you think you got the most appreciation out of, and you're just not going to get much more out of it. So you reorient that money to a higher cash flowing or a stronger appreciating investment. So whether it's the right time is completely portfolio sort of dependent on what your risk tolerance is and such. John might have like a better answer sort of towards the more macro side of things, but when we look at sort of operating and portfolios, it's hard to recommend to buy or sell on any individual market.
I'll come in with the same nuance, and say it to counter you, Dylan. It's not time for macro. That today is time for micro. We've definitely, I think, moved from a position of a rising tide lifts all boats. We're not in that market anymore. We are. We can't count on that much cap rate compression for some of the inflationary reasons that we talked about earlier. That is, in my opinion, going to keep cap rates within a certain window on a forward basis. We can't necessarily count on going back to the days of a 4.5, 5 cap. You know, with that, I think that it's market specific, and then it's even sub market specific within Phoenix. I think that I'm more confident from a net domestic migration standpoint. Markets that are doing well, attracting people from the U.S. from other parts of the U.S. in as a from cost of living and lifestyle benefits. I think that those markets retain their advantages. I'm a little bit more sanguine on markets that are more dependent on international demand at the current moment. So I think that Phoenix is more of the former than the latter. So I'm pretty confident from a forward demand standpoint. The one thing that I don't necessarily know a ton about, Phoenix, the Arizona market, that I would certainly, preach that you fully grasp and get a handle up before making a large financial commitment is the insurance markets there. You've seen that in places, especially within Florida, Texas, the last number of years. The home prices going up, that causes large increases in the insurance market. The reinsurance markets have increased in insurance prices, but then also what are the forward-looking risk factors locally that would be specific to that market? Is that going to change your underwriting materially? I think that getting a sense of the state level administration of some of those markets you see in places like Florida, where it is, the state level administrators are publicly elected, so they have incentives in order to keep the rates down, and then all of a sudden those markets end up going belly up as a result. And then it's either you can't get insurance or it's exorbitantly expensive. I don't know enough about the Phoenix and the Arizona markets to render a decision there, but I definitely know if I was investing in Phoenix, that'd be the first thing I looked at.
I love it. Well, John, Dylan, thank you so much for your time today, your presentations. Thank you to everybody listening for the questions that you've asked. If you enjoyed today, we have some amazing webinars coming up. Our next webinar will be this Tuesday with Brandon Turner, the former host of the Bigger Pockets podcast. So if you'd like to save your spot, we'll be dropping a link in the chat for you now. You can use that link to register and attend that webinar as well with Brandon Turner. And lastly, if you have rentals and you're looking to get some of your time back, grow your portfolio, we'd love to help. If you're not already using RentRedi to manage your properties, we're the leading all-in-one app for independent investors to self-manage their properties themselves. Our goal, our mission is always making it the simplest, most affordable, most successful way you could possibly manage, whether that's collecting rent, managing maintenance, screening your tenants, listings, handling any of your accounting. And we take a lot of pride in making it cost effective, whether you have one unit or you're scaling to hundreds. So $12 a month, you're paying less than most pizzas you'd have to run your entire rental portfolio. So we'd love to set you up with a call anytime. We'll drop a link in the chat if you'd like to talk with someone on our team. You don't have to, but we're a pretty friendly bunch, and we're always happy to chat with anybody that'd like to. So thank you again for everyone that's joined us. I hope you enjoyed the takeaways, the insights from John and Dylan. And if you are already managing on RentRedi, we're excited to continue to be a part of your journey and your path to success. So thank you again, everybody, and thanks again, John and Dylan, for joining us today.
Thanks so much.
Yeah, thanks.